Well, welcome Colorado Proud members to our webinar today. Just share some information before we get started. Today, our webinar is a CPG masterclass. So I'm super excited. There's always so much to learn, and we're lucky we have these experts from Bravo CPG. We have Katie Horgan, who is the founder and CEO, and we have Jeremy Brooks, the director of operations. We just ask that you mute your microphones. This will help eliminate any background noise as our speakers are talking. We definitely want and welcome questions. So raise your hand or type them in the chat and we'll make sure we get it addressed. And of course, we'll always ask for questions. So feel free. And since we have this great group, let's make sure we, utilize their expertise with us. And if you have any questions after the webinar, reach out to me, Barb Howe. This is my email address, barb.howe@state.co.us. Great, excellent. Well, we'll go ahead and get started. I'm super excited. We have, as I mentioned, Bravo CPG here. And just a quick comment about this company. They are an embedded CPG ops team for the growth stage food, beverage, beauty, and wellness brands. So they cover a lot of ground and they have expertise in all of these areas, which is fantastic. We have Katie Horgan. She's the founder and CEO. She has held operations, logistics, and supply chain roles at multiple VC-backed CPG brands and started Bravo CPG in 2018 to help early and growth stage brands get better access to top operations talent. She is a Marine Corps veteran, a graduate of USC and Columbia University, and splits her time between Bend, Oregon, or Austin, Texas. Welcome, Katie. Thank you.
Thank you.
And we have Jeremy Brooks, and Jeremy is the director of operations. And Jeremy has over 10 years of experience in manufacturing, supply chain operations, and organizational leadership within the food and beverage CPG sector. He has a proven success developing long-term strategic initiatives, improving operational efficiencies, scaling production capacity, and champion cross-functional collaboration in fast-paced environments. We're super excited to have Jeremy because he has worked on many different brands that I think we're all aware of. Just to name some, Fancy Sprinkles, Goodles, Verbe Coffee Roasters. So we're excited to have the caliber of guests that we have today. So we'll get started. And really, we want to talk through CPG, all there is to that, and what we can look at for smaller mid-sized companies, whatever stage you're in, early, very early growth, mid-growth, as you're expanding and move and go on from there. But let's start first with just kind of thinking back to when you guys were, like, say, at the $5 million mark versus to where you are, say, at 15 to 20 million. What was the single biggest thing that surprised you about that journey, and what did you not see coming? Katie, do you want to start?
Sure, I can start. I'd qualify that by saying that the journey is different for every brand. We see some large brands, that are over 20 million that are not complex, and we see some $5 million brands that are increasingly complex. So every situation is different. I would say, for the brands that are, once you get to about 5 million, slapping it together no longer works, for lack of a better way to say it. Homegrown systems, people double, triple, quadruple hatting, things just start to feel unwieldy. And you really need processes, systems, clearly defined roles inside the organization, and also a deep understanding of your financials. It's really, the mark where businesses start to turn the corner. Complexity starts to get to be a little bit more, and that complexity cannot sit on top of systems that are not built to scale. So oftentimes we see brands start to reach out for help at around that mark and try to make hires at around that mark. And then, once if you've proceeded to the $15 to $20 million mark, usually, not always, you have more robust systems in place, you have clearly defined jobs, and you have enough support instead of one person trying to do 3 or 4 different jobs. So there's lots of there's lots of differences between brands at those stages, but those are a few things that we see.
Very interesting. Jeremy, what about you? What are your thoughts? What was maybe one of the single biggest things that surprised you?
I think it's just how fast it happens. It really does happen quickly. And, you go from, 5 million, and getting from that you would think that it would happen slowly and like gradual growth, but once you potentially get into like a major retailer or a very large partner, that growth happens faster than I think a lot of people anticipate. And it's just making sure that you do have systems and processes in place, hopefully beforehand, but a lot of times as soon as you can to ensure that you're set up for success. Because yeah, it really, really happens quickly. And I think the biggest thing is just understanding, can you continue to support this? I think it's important to make sure that not only your internal teams, but also you're setting your partners up to succeed, because that's such a really, really important part of ensuring the success of that is making sure that you have enough supply, making sure that you have the support, that you can provide everything that's needed by your partners. And I think it's really easy to say yes a lot, but I think it's also important to know when you're ready and when you're not ready to go to that next phase of the 5 to the 15 million.
Interesting.
Yeah.
What
I'd
was
also
maybe
add one more thing. Oh, sorry, just quickly, I'd add one more thing about like the cost of the opportunities as your business gets bigger, in particular inventory costs.
okay.
And then as you get larger, obviously like your headcount gets bigger, like you just need more dollars to run the business. And I think like Jeremy said, that can happen very quickly, some, slowly and then all at once. And now you're faced with, a PO that's several hundred thousands of dollars. And there's a gap between you when you pay the manufacturer and when you actually get paid, and you're floating a lot more cash in addition to having to spend more to run your business because you have more headcount. The dollars can get associated with that growth can get very big very quickly.
That makes a lot of sense. It's probably something that really is a surprise how it can just exponentially go up. It's not as you're ticking along, all of a sudden,
Right.
wow, that's a much larger situation that we have to deal with.
Mm-hmm.
But you both mentioned adding people, which as a business grows makes a lot of sense. So thinking about building out a team and hiring, at $5 million, I imagine a lot of founders are still wearing multiple hats, right? They're doing everything, maybe not everything, but almost. What is the first role you actually need to hire? And how do you know if you've waited too long? Katie, do you want to start?
Uh, I'll go first. I'd actually say a CFO. This is outside of operations. Like it doesn't necessarily have to be a CFO. It could be like someone a little bit more junior than a CFO, but someone to help you understand your numbers and make sure that your books are clean so that the data that you have is actually supporting decisions. So that is absolutely critical, I think, to know your numbers more than anything else. That's the first detailed hire. I'm sorry, specific hire I would make. On the ops side, what we recommend is really first hiring a very strong doer. So like an ops manager, somebody who is not right out of school, like 2 to 3 years out of school, someone who actually can manage and knows what things should look like. They're not director or VP level, but they know enough to be able to self-direct and to ask the right questions. Getting a really strong doer and executor in there can relieve the founders and the leadership. A lot of times we see people wanting to make a director hire, a VP, a COO ahead of, and all that does is duplicate leadership. What you need is a doer to elevate the leadership first, in my opinion. And again, it's case specific, but like a lot of times we see that that's the best first step because it's going to elevate the existing leadership and get them out of the weeds. Another leader is just going to be at the same level. It's not going to be picking up the phone to unblock a freight shipment.
Oh, very interesting.
Yeah, and I 100% agree with that, even down to the financial side, because she's right. And, I think that we can maybe discuss that a little bit more in detail later on. But I think the important thing is to effectively take all that operational day to day, take all those hats off the founders, and then hand them off to this manager to allow them to focus on strategy. Because the only way you're going to get to that next step is just to kind of alleviate them from those day to day tasks. And we still see a lot of founders that do operate that way, but taking that just those day-to-day functions off on the operational planning, the procurement, all of those things by having a manager is extremely important to allow them to do what they really do both best, is like support the future of the company, because that's it's core to who they are, why they found the company, and you need to allow them a space to do that.
No, that's really good feedback. Interesting. Jeremy, how would you know in this situation if you've waited too long to make that first hire? Not first hire, but in the first role as you're growing.
Yeah, I think it's, you know, It's hard to know that, and I think oftentimes you don't know it until maybe you're experiencing it. But
Sure.
I see whenever you're seeing either you're getting consistent bad results, like you're not able to dedicate the time that you need in order to create strategy and structure and system and processes. You're kind of just it's a lot of band-aids, and I think once you get to that point, you've realized that this is when it's time that you need to bring in additional support. I think a lot of people, especially founders, feel like they can handle a lot of the tasks and they have the bandwidth. But I think it's whenever you're finally seeing that you're not really able to make the progress that you know the company needs is when you need to bring in those additional people.
Well, very good point. Katie, anything to add to that about maybe how do you know you've waited too long in a situation?
I'd color my, or I'd add before I say my point, I'd say budget. Budget always gets a vote here, so that's a qualifier. But I would say, if as a founder or a leader you find yourself doing very low level manual tasks, ask yourself if that's the best use of your time. If you are spending 2 hours trying to get a shipment into Amazon, a lot of times founders don't put a dollar amount on the value of their time, but it does have time. There's also opportunity cost. You could be raising money, you could be building a partnership, you could be selling. I'd say, yeah, if you find yourself spending quite a bit of time on that manual lower level work, like it's already too late. You need to get somebody in. Not too late, but you should have someone in there like already.
That's an interesting point. Good. So even thinking about that, for founders who are still really in the weeds, they're still kind of like holding on to it. How do you know really, or what would your advice be for a founder, when it's really time to let go of those the day-to-day execution of the business, and what does that transition look like, Katie? Like, when do you know, and how do you do it?
Yeah. And listen, I've struggled with this in my own business. Like, and to a degree, founders are right. Like when they say, or when they think like no one's going to do it as good as me,
Sure.
you're probably right. However, if someone can do 80 to 85% of it and allow you to move on, that's the right choice. If you want to grow, so I would say, like, if you find yourself, like I said earlier, if you find yourself spending a lot of time doing that tactical manual work, it's already time to delegate, and forcing yourself is necessary. It will take more time in order for you. You're going to spend more time before you're able to step back and spend less time, because delegation takes work, right? It's onboarding a new team member, it's translating information. That is an investment. And that's a lot of times what stops people from doing it. Number one, because they think like it's too precious to hand off. I can guarantee you're not the only one who can do it. Like most people can do it close to, if not the same or better than you can. And yes, there is an investment up front, but you have to make space for delegating. And sometimes it just comes to a forcing function. Like you reach a breaking point. Like this has happened in my own business. You can only do so much. Eventually something cracks and it drops off and you let it go and it flies, So sometimes there does have to be a forcing function, but we would encourage people to get ahead of that before it gets to a breaking point.
Well, that makes a lot of sense. Thank you for that. Jeremy, what are your thoughts on this?
Yeah, I think Katie covers a lot of the
Mhm.
areas, especially whenever it's like looking at, even she mentioned earlier, like, is it a good use of their time? And I think it's whenever you start getting into a lot of these businesses and you start onboarding like multiple retail partners or different types of distribution, a lot of the work is it's repeated over and over and over again.
Okay.
And that's just not a good use of a founder's time. You need to either bring in additional
Mhm.
resources to help support that or find different ways to automate it. Still, those things take time, the founder's time and resources in order to dedicate it towards handing it off. But it's understanding before it's too late, like Katie said, on, okay, this is not a good use of your time. You need to make sure that you're dedicating enough time to then hand it off and provide the resources to do that effectively.
I'd also say like there's no perfect time to do it. Like some of the things I hear when we talk to brands about potentially supporting them is, oh, well, I want to learn it first before I bring in someone else to delegate to. Or I want this process to be tight. I want to fix this thing before we get someone in. Yes, and those things can be true. And also, like, you don't have the time to slow down and like fully learn something, and maybe it's not the best use of your time. So that's some of the pushback we get sometime. And just like with many things in life, there's rarely a perfect time to do it. Sometimes you just have to rip the band-aid off, especially if it's tactical, repeatable stuff like Jeremy said.
That makes a lot of sense. Good advice. Well, let's move into thinking about getting bigger, launching into retail, for example. I think a lot of companies, it's really cool. They get a new account, but then it's kind of like, now what's next, right? Good question. So walk us through what happens the moment a retail account says yes. What are the first things that a brand might need to do that they probably aren't thinking about right off the bat? Katie?
I actually think Jeremy is probably better equipped to answer
Okay,
this, although we do have a post coming up that like specifically details this, but I'd love to hear Jeremy's thoughts first.
perfect.
Yeah, I think it's hard. I think a lot of times, especially for founders, you get excited and you feel like, yes, I've done it, right? But really, that's just the beginning. There is a lot that you need to start working on. I would say that a lot of the times, like I mentioned earlier, it's ensuring you have enough supply to support the demand. I think a lot of people underestimate exactly what that's going to look like. I think it's really important that at the beginning, typically they give you enough lead time depending on who you're working with, understanding that there's going to be a pipe fill. You got to make sure you have enough supply, not only for their warehouse, but also on shelf. And making sure that you know what that number is going to be like. Some people don't have the budget to work with a broker. A lot of the times, you're using a lot of your own resources. And I think it's important to get as much information as you can to make sure you're as prepared for success as possible, ensuring you have the supply. And when I was at Goodles, we went from doing a couple thousand cases a month to our first order that came from Target, and they wanted 7,000 cases of all SKUs, and they wanted that in their first shipment. And we immediately were like, oh my God, this is going to be a task. And of course, it's the mountain you want to climb and get to the top of, and we made sure that we were able to do it. But it was quite a shock when we got the first order in, because we were using a lot of our understandings of the industry and what the turns and velocities were going to look like. We looked at spins data. We went to different resources and our network and tried to figure out what should we be looking at. So we used our best guess, and luckily we were able to put ourselves into a point to succeed. But that immediately went back into recovery mode, because we basically stripped all of our supply to fill the orders for one customer, and then went immediately like, okay, now how do we get more into our warehouse to make sure that when their next order comes through, we're not short shipping them, they're not going to be out of stock, and different things like that. So for me, it was, especially since I'm in operations, it was like supply was everything.
Mm-hmm. Well,
Yeah, I'd say a couple of the things I've seen people accept opportunities like nationwide launches in Target, Whole Foods, etc., without even having a co-manufacturer. Like we talked to one brand who was doing self-manufacturing, said yes to those two opportunities and didn't even have a co-manufacturer. So what we were trying to express to them is like, this is a huge investment. Obviously, you're going to be bending over backwards to make this launch, and you don't actually know what the second order is going to look like. So this is quite a bit of outlay in terms of money and time, and like completely changing your business model for this one opportunity that may not yield what you think it's going to be after the first order. We've another example, like to Jeremy's point about the much larger order quantities, is seeing brands who get these big opportunities and their manufacturers have never actually done that kind of a quantity. So like there's a potential for quality control problems there. Like they haven't actually proved that they can do it, right? And that's where like redundancy in the supply chain can come in. Like, but a lot of brands don't have backup co-mans for various reasons. But that's another thing. If your manufacturer has never actually done that, that's going to take quite a bit of handholding from you, the brand, to make sure that they produce that stuff on time and also like with the quality that you're expecting.
That makes a lot of sense. It's great to grow, and I think, do everything you can, right, to understand what does that look like. And if you get it, have the team ready to bring, you can't figure everything out, but boy, think through how do you accomplish that first large shipment? Because to Jeremy's point, you'll go through all your supply.
Yeah. And I wonder if Jeremy has a thought on this, but like, I feel like when brands see this, they think this is it. This is my only chance and I better do it. And no one's ever thinking like, I have to say no right now, and like trusting that something will come back. And there's probably some truth to that. Like those opportunities don't come across, your desk all the time, but it seems to be in our industry. It's like, this is it. Do or die. This is my one shot. There's no belief that there's another opportunity. Jeremy, you correct me if you think that's wrong.
No, I think that's completely right. And I think you have to be really strategic in understanding what your bandwidth is, not just in terms of like your supply capacity, but also your internal team's capacity to support these accounts appropriately, to make sure that you're setting them up for success, because it's not just being able to meet the supply. Then there's also all these other things that are going to happen, which is like there are going to be follow-ups, there's going to be corrections, there's going to be all of these different things that happen. And yes, it gets more complex as you get more retailers, but even one can be challenging enough that you need a team to make sure to support that. So saying no to ensure that you can provide the right level of service to the ones you said yes to is extremely important. And I've worked with businesses where we said no a lot. And that's why you have to be selective on who you say no to, because Katie's right. Some of them just won't come back.
Right.
Some of them, though, will come back because they realize that you're the one who said no, right? You're the one who got away. They want to chase you and they want to get you into the store, especially when you're a brand that they can see has a lot of backing behind it. There's a lot of popularity there. You're at one store and they want you no matter how long it takes. So it's okay to say no, because there is a likelihood that you're going to get to say yes eventually.
That makes a lot of sense. I mean, I always thought it was interesting as a method to also talk with your account and see what are some other options of maybe all or nothing, right? Like, can we take a smaller percentage in the beginning so we can ramp up appropriately? In my mind, it was always worse to stumble once you got in than can we start a little slower than all the stores? Can we take 3 first? It's something like this where you're in, but you're showing them that you're responsible enough to be, because you don't want to stumble. All of a sudden you can't supply them. That could be a bigger hiccup.
Yeah, and I think that brings up another good point, is when you say yes to one and you can build enough of a case on why the others, even though maybe you said no before, they should say yes now, because you've shown you have the velocities, you have the turns, customers want you, and now you can go back to them and say, hey, I wasn't able to say yes before, but look at the data and what it's showing and why we should be in your store.
Very good point.
I'd also say that, I mean, especially if you're a smaller brand, you don't have a ton of negotiating power with the retailer, but you can always try. We see people just accept whatever, if Target comes knocking and they say these are the terms, people just accept it. But like, maybe they're not ordering in full pallets and that would be better for you. Maybe the lead time is too short. Maybe you need a little bit of extra time, or, I mean, everything in life is negotiable. They may not say yes, but I think it's worth trying rather than just saying they set the rules of the road and I have to do this, even though it's going to break my business. So like, we would encourage people to try to negotiate where they can. You might get a little something, you might not, but it's better to ask than to just accept something that's going to be really hard for you to do, I think.
Well, that's really good advice. And even along those lines, we think about other details like routing guides, fill rates, chargebacks. Those come with these accounts. Not all, maybe, but let's face it. I mean, these are parts of doing business with retailers. So they feel like a maybe small in the beginning. Where do brands mostly get caught off guard on that operational side with a new retail relationship, Jeremy? What are your thoughts on that? When do they kind of hits them that they're off? They didn't see that coming.
Yeah, I think there's, depending on the size of the retailer, I think they're a little bit different in terms of where you see a lot of the chargebacks or the compliance related fines. What I commonly see, though, is the ASN compliance is you're not giving them advanced shipping notice. They're getting something they're not expecting. Therefore, they're giving you these miscellaneous fees that you're not expecting. And those can add up really quick, especially depending on how large the orders are and how frequently you're shipping them. So I would say ASNs are one of the really big ones that people just tend to not really think about a lot, because you're thinking, well, I'm shipping it in full and I'm shipping them what they want. What's the problem? But a lot of these major retailers have to know in advance, because they have to also have their warehouse prepared for everything that's coming into them.
And I would say one other piece of advice I've heard many people give is to have your case pack size be 6 units or less, largely due to the free fill. If you have a 12 unit case pack size, then you're going to be free filling a case of 12. So you need to have a case pack that of ideally 6 or 4 that is just less expensive for you to free fill.
Interesting. So thinking about all of this, what do you think is the true cost of a retail account in terms of not just slotting and demos, but the full operational burden? Jeremy?
Yeah, I think it's challenging to know the true cost of a retail account because they're different and they have different requirements. I mean, some of them are going to require a lot more trade spend and promos in order to get the velocities that you're looking for versus some other local retailers who may not require a lot of those, and you might see better turns, especially like you said, if you're working within Colorado, people are very familiar with your brand. They're going to seek you out. You're going to get the turns. It's maybe not necessarily going to have the same requirements. So understanding the like true cost really just comes down to how much is really loaded in there. And I think
Mm-hmm.
you can get a misleading reading when you're just looking at your cogs, because you need to understand what the fully loaded cost is of servicing that retailer. And it comes down to like, what are the shipping costs to get it in? What are these hidden fees that maybe you're not seeing, like we just discussed, of the chargebacks and the compliance related fees? And so I think that's important to understand all of those things before, again, you say the yes, because that yes could make or break your business.
Although I might argue that you probably don't know the true cost until you're actually in there. Would you agree with that, Jeremy? Like the real full cost?
Yeah, we do a lot of, before we would do a lot of cost analysis to understand, like looking at shipping lanes and the cost, what their cost is, what their margin targets are. And you're right. I mean, until you actually are doing it, you don't fully know it. You just have to do
Yeah,
your best guess to understand if
it's
it's the
close.
right business move.
Yeah. It's always more than you think it's going to be, is what I would venture to say. Yeah.
That makes a lot of sense. I mean, you're not going to know every single thing until you're kind of right in the thick of it. So when does a new account actually start making sense then? If we kind of wrap all of that up, Jeremy, what would it look like for you?
Yeah, I think that most of the time, like especially in the first year, I would say like if you're just looking at financials, like Katie said, it doesn't really make a lot of sense. I mean, you're spending a lot for the pipe fill, you're spending a lot for the placement, you're doing a lot of promos. I
Mm-hmm.
think it's really only after you understand all the costs associated with it are you really understanding whether or not the account makes the right sense. And you have to do your best to understand if it's the right account to go into based on your initial
Mm-hmm.
analysis, and then understanding long term if it makes the right sense. Because you know if you are sticking with a business or you're keeping products in that business that don't make sense, then yeah, it can be really stressful on the organization. But whenever you've done the work and you understand what the business looks like to service that, those accounts work really, really well. And I think those are the ones that help grow your business. And a lot of the times what I've seen that works well is working with like smaller, maybe regional stores, right? Because then you're able to work through a lot of the infrastructure and the processes to make sure that you can service a larger account. So working with like a Hy-Vee or a Meyer, an HEB, something like that. They're smaller accounts, but they still have the sophistication that larger retailers have. So you know how to do like your EDI setup, and you know how to do your fulfillment and all of those different things. But it's a little less of, you're putting everything on the table just for one account. You can learn the
Mm-hmm.
ropes. There's a little less at stake, but you still are able to learn a lot, and then you can grow and service bigger accounts.
Interesting. Katie, anything to add to that?
I was going to say the regional thing as well. And if you could go further and somehow get your co-man and your 3PL in the region that you're playing in, it's the logistics. I mean, especially if you have like a perishable product or frozen product, like those, moving that stuff around is going to kill you in terms of fees. So the few brands I've seen that are actually profitable and bootstrapping have employed the regional strategy. That does, you grow a little slower, but maybe that's not a bad thing. Maybe we need to normalize that slow, steady, profitable growth. It's not as sexy, but it works, you know?
Sure.
Yeah.
Wonderful. Well, let's move on to talking a little bit about integrated management systems. A lot of brands bootstrap to, $5 million on QuickBooks and Google Sheets, right? They're both fairly easy to use and they work to some degree. What's the specific moment, or maybe even the specific pain, that tells you it's really time to look at um, an IMS, ERP, and an enterprise resource planning system?
Yeah, I would say favorite answer. It depends. It really depends on the
Yeah.
complexity of your business as opposed to the revenue size. Like the last startup I worked with in New York City was $100 million business, and we were doing all of our demand planning on spreadsheets. So you can get pretty far with spreadsheets, Google Sheets, and QuickBooks. Like you really can. So I would say like once the complexity once you start losing track of things and you're feeling like there's the assumptions are changing, you can't keep the data sources clean, and that's more of like a feel than like a hard line in the sand. That's when a system can be helpful. I would say one use case I see people coming to me with when they talk about an IMS ERP is the desire to get a better view into fully landed costs. That is, if you're feeling like that is really difficult to manage, and you want that clarity, that is one point at which a software might be helpful. I will say that I get a lot of people telling me that they want a piece of technology, but their processes, that they want to automate and streamline using the tech, are not actually set up yet. So if you don't have your processes set, if you don't have like a clean, master data sheet and like a clear understanding of how your pieces fit together, putting a piece of tech on top of a shaky foundation is not going to work. And you're just going to end up spending more time and money trying to get the system to work on top of a shaky foundation.
That's really great feedback. Very interesting. Jeremy, what are your thoughts?
Yeah, I think Katie nailed it in terms of just like how complex the business is, and you can get very far with Google Sheets and everything like that. But I think it also goes down to what kind of manufacturing you're doing. Are you doing in-house manufacturing? Are you doing, turnkey tolling? All of those add complexity. And as your business scales, especially as you launch more SKUs, you have more retail distribution, you maybe have more contract manufacturers. That's where an ERP is going to come in really handy, because you're going to be able to centralize everything, have that top-down view, and it's all going to be in one place to systematize it, create a lot more accuracy in terms of your reporting, your planning process. And that's where it really comes in usefulness.
Interesting. Well, when you're thinking about options of these programs, what do you wish someone maybe had told you before you went through that process, kind of to prepare you as you started looking into all the IMS and ERP options?
I would say platform agnostic, the true cost of implementing, not only implementing it, but what happens after implementation. Because a lot of times keeping that system up and running, making sure it's a system of record, fixing issues that pop up, that's like a quarter to a half of a full-time headcount's job. And most people just assume, oh, we'll learn it and we'll just do the work alongside of our other work. But no, it actually requires additional labor and support from your team to make sure that's actually being used. So accounting for the true cost. If someone tells you they can onboard you in a month, absolutely not true. Like 6 to 12 months, honestly, to really fully integrate a system and have it humming. More if it's NetSuite. NetSuite, I would say up to 12 to 18 months. So yeah, true cost of getting in there is really, and the time to onboard is what I wish more people knew.
That's
Yeah, I think it goes into that same part is making sure you really understand what the right one is for you, because you're going to meet with a lot of salespeople and they're going to tell you it can do all your wildest dreams, right? I mean, that's what they're doing. They're trying to sell you the product for the integration and all of the different things that come with it. But I found that not every tool is right for the different businesses, right? I've used a lot of different MRP and ERP systems, and they're all built differently to provide different services to those organizations. And I think that's really important, is do your due diligence, make sure it's the right tool for you. Just because you worked for a company that maybe used NetSuite and you heard it's the industry standard doesn't necessarily mean it's the right tool for you, especially with all of the, a lot of times people will have an IT person specifically that does manage and maintain all of those systems. That may not be the right fit for you. So I think doing that, and then ensuring that whenever you're ready for this, and this is the one area where I wish I would have had a little bit more insight, is making sure you're planning for the future state of where you want the business to go and not just your current state. Because a lot of times when you're a startup and you're moving really fast, you don't have really good systems already in place. And if you just copy and paste those into a new implementation, you're going to end up creating a lot of failed processes as you grow. And a lot of the times you can't change those once they're integrated. You kind of have to live with them, or you have to go through an integration again. And that is a very painful process.
Right.
Yeah, I love that one. And because you have to think about what does it need to be capable of doing. You don't want to stay in the same place forever. So 5 years down the road, or whether you're looking at, millions of dollars down the road, what does this thing need to be able to do? Makes a lot of sense. Well, let's talk about supply chain. You guys have mentioned it obviously in your fantastic conversations. But let's talk about the build out of a supply chain network. At what point do you start thinking about a co-manufacturer or a 3PL redundancy? And what does network optimization actually mean in practice for a brand at this stage? Jeremy, do you want to start?
Sure. Yeah, whenever I think about this, I kind of feel like redundancy and optimization are two different directions and they're kind of opposed to one another. Like one is redundancy is buying insurance, and so you're kind of giving up margin and adding complexity to protect against failure. It's like your insurance policy versus optimization, which is simplifying everything and trying to get a better price. So a lot of the times, like when you're looking at optimization, like of course it's better to just have one co-man. Of course it's better to have one 3PL. You're consolidating everything into one centralized place. But then recognizing, well, where's the point of failure? Because if you have a co-man that's shut down for any given reason, then you now have a point of failure. If you have a 3PL that can't fulfill, I mean, we have a Walmart just north of Fort Worth that got hit by a tornado like 6 months ago, and that entire DC had to go shut down, right? So I think that's where kind of looking at them differently to understand when is it the right time to do that, because they have different moments on why you would want to do that depending on where you're at in the business.
Makes a lot of sense. Katie, do you have anything to add?
Just on the network optimization front, to me, that really means like where are your partners and what is the efficiency of moving around between those partners relative to your customers. Whether your customers are, direct to consumer customers or a retailer. Like we have some brands who, like their D2C customer base is very localized in like on like the East Coast, for example, but they're manufacturing in Washington or something. So network optimization to me just means like the web of support relative to the location of your customers. It is difficult to, especially when you're smaller, finding a co-man to take a chance on you, is hard. So finding the right partner, you may not be able to do that. You likely can't do that until a little bit later. With the manufacturer, like placing that partner in an ideal location, that may come later. 3PLs, I think you have a lot more flexibility because there's a lot of 3PLs out there that will support smaller brands. You can be smart about who you select. You can select somebody with like a Utah and like a Texas location, or somebody like bi-coastal. But the manufacturer is, I think a lot of times you're kind of stuck with who will work with you and make your products well. So that part may come a little bit later.
Interesting. Thinking about what Jeremy had said about disaster planning, right? Over the years, I've worked with a lot of companies that they actually put that into some contracts about what is your backup plan? What happens if this one location, whether it's a manufacturing location, to your points about co-manufacturers, or a logistics company, your DC, what's your plan? How are you going to supply me so my business keeps running? And it's just one more thing that businesses to think about is as you grow, your customers get bigger and you need to start thinking about some of those things. So this makes a lot of sense what you're saying. So walk us through the difference between a turnkey and a tolling arrangement with a co-man. Who wants to start with that one?
Sure, I'll start. So turnkey and tolling, and I guess the most basic sense is turnkey. You're essentially buying a product, a finished good product from a manufacturer, and they're delivering you a finished good. So you're not worrying about all the different material inputs and things like that. Versus tolling, which they're providing you with a service to essentially take all those raw materials, convert them to a finished good. But there's nuances to turnkey, and I've worked in other like kind of turnkey scenarios where you are essentially directing them on which materials to buy and make your product, but they own the supply chain, but you're still buying a finished good. So they're still making it to your specifications, your formula requirements, everything that you stipulate, but it's still a turnkey product because you're essentially just buying a finished good from them. And there's definitely advantages to one or the other. But on the tolling side, you really all you're getting the labor. You're getting a lot of the standard common materials like shrink wrap, sometimes pallets, the glue to close the box and things like that. Okay. So that's really essentially kind of the real main difference between the two.
Interesting. I like that. Katie, anything to add?
I did a post about this a couple of weeks ago. Again, a lot of times we'll hear from founders like, "Well, I can do this myself, and so I don't want to pay the manufacturer to do the procurement. I'm gonna, I'm gonna do this myself, and I don't need the turnkey solution." Again, yes, you can do it yourself. What is the cost of your time? And also, what are your supplier connections? Like the manufacturers may have access to things at better prices, for example. So there's a lot of considerations there, not least of which is the time and complexity associated with doing that thing yourself. So I think in the post we had a couple of weeks ago, we recommend within reason, as long as the pricing is like relatively reasonable, paying a little bit more for the turnkey model so that it's managed for you and you know stuff shows on time. You're never going to be late on a production run because your shipment of like tapioca flour or something didn't come in because you ordered it from someone off Alibaba or something, wherever you got it from. So it can be a really good tool initially, even if it appears on paper to be slightly more expensive.
Yeah, and I think that's a huge point to make because I think a lot of the times people are seeing, well, my costs went up when there's all these hidden costs that they're not aware of or they're loading into their products.
Mm-hmm.
And, like you mentioned about like bulk buying or having bigger volume discounts, there's a lot of materials that are very common across multiple different products like salt or flour or whatever it may be. And I went through this transition where we were doing tolling, and then we went to turnkey and we directed them what to buy. And a cost of, I would say, half of our products went substantially down because they had better negotiated rates with suppliers to bring down the cost of the raw materials way more than we could have ever. And that essentially offset the administrative fee for doing all the procurement for us. So a lot of the times you end up either at the same cost or better because they're able to get better rates.
That makes sense. What are some trade-offs, do you think, between the two that maybe a lot of brands don't think about up front, Jeremy?
Um, well, I think a lot of brands, and I think Katie, you've probably seen this too, especially with like founders who want to really own the relationships with the suppliers, or they want to own that supply chain. It's kind of handing that over is I think
Mm-hmm.
challenging, and sometimes you lose that kind of control over your supply chain, and I think that can make a lot of people nervous. The upside to that is now you freed up a lot of cash that that you
Mm-hmm.
didn't originally have because now the procurement's loaded into a final finished good that you pay for when it's shipped and ready to go, rather than carrying the cost of all these ready raw materials, which have to be stored or they're sitting somewhere until they're converted. So that's the upside to
Mm-hmm.
turning over that supply chain.
Interesting. Katie, anything to add?
I'd be curious what Jeremy says about this, but I would be careful if if a co-man will not tell you which suppliers they're working with, because number one, obviously you need to make sure that they're providing the quality that's supporting your products. And number two, if you ever need to leave that co-man and you have no insight, if it's like a total black box and you're starting from zero, I don't know how many co-mans keep that close to the chest, but we've seen that a few times with co-mans, just like it's a total black box, which doesn't feel great. So I would say if you're going with a turnkey model, at least having some visibility into the suppliers that they're using is important. Um,
Yeah, and I've seen that as well. As some suppliers just won't want to share specific, suppliers that they're buying certain ingredients from, and it can be challenging because if you're wanting to understand, well, what's the cost in there, who are you getting it from, so that you can try to dig a little deeper to understand maybe if there's an area for cost savings or if maybe you want to vet a different supplier, that can be challenging. I think the other area where you can experience this as well is whenever you're going full turnkey, depending on who the co-man is. Sometimes they want to own the IP to the formulas. You're essentially buying a product from them. They own that formula. It is not yours. You own the brand. So again, like if you want to own the IP related to that formula, sometimes co-mans won't allow you to do that, especially if it's a turnkey, because essentially they see that as their product. So that's another area where you just have to be comfortable with, sometimes what you're building is a brand, and that's where the IP and the intellectual property sits, is with the brand, not with the formula. You just understanding exactly how you're positioning that so that you know exactly what you own and you don't own.
Makes a lot of sense. Some good questions to be talking to your partner with, your co-manufacturer, your producer, if that's what you're doing. Well, As we get close to wrapping up, as far as this portion of our discussion, let's talk about cost of goods and margin improvement, because those are critical in a business. Margins tend to get squeezed hard at this growth stage. More retail, more freight, more complexity. So, where do you typically find the most actionable opportunities to improve cost of goods? Katie?
Ooh, actually, the first answer that's coming to my mind is price point. Setting the right price point relative to your costs. If you don't truly understand your COGS, people know what margins to expect with like retailers and distributors, etc. But if you don't have the right input on the cost side, you can set your price point too low, which just means you're basically you're never going to get out of the gate. That's the first answer that comes to mind. Um, I don't know. I mean, everything's negotiable. I think like freight is obviously a huge percentage, especially if you have a product that's perishable um, or frozen. And there's just some decisions that you can make when it comes to shipping options, like for direct to consumer orders. Like maybe you have to set a shipping fee in order to offset your costs. Like there's ways to offset those costs. Also, like pallet optimization, like a lot of people just stack things on, on a pallet, and they may not be aware that you can get 20 or 30% more by kind of doing the Rubik's Cube kind of situation. So I'd say freight is probably a big opportunity. And then we see people overpaying for like simple things like cardboard boxes. Like everyone thinks they need a branded shipper case. Do you need a branded shipper case? Maybe not at this point. Maybe that's later. You can use custom tape, things like that, like paying for things that are really not driving a customer decision at this point. No one's going to see your case back except the guy cutting it open in the back of Target, the small things like that. Those are a few things that are coming to mind. I'm sure there's more.
Yeah, and when we're talking about scaling the business, this is where we saw some of the best cost savings whenever we were at Goodles, was really understanding with that volume now comes negotiation, right? And this isn't to like squeeze suppliers; it's you're creating efficiency on their supply chain as well, and you should reap the benefit of that efficiency. So if you went from buying maybe 2 or 3 pallets of flour, now you're buying a full truckload, you should be able to negotiate better prices with your raw materials in order to see those flow through
Mm-hmm.
into your COGS. And that's an area where we spent a lot of time understanding, like, okay, where we have the most amount of spend, let's focus on those first, and then we work our way down to make sure that
Yeah.
we can pull up the most amount of savings through our raw materials. And that includes packaging, right? If you're able to run however
Mm-hmm.
many units, 3, 4, 5 times more, well, then you should get efficiencies with that. So you should see some cost savings. And then the other
Mm-hmm.
things, like maybe you go from, you're using 5 inks, let's go down to 4, and you're using CMYK or whatever it may look like. Building the brand and having that really expensive product maybe in the beginning to really create that, like, the visual appeal makes a lot of sense. But there are really simple ways that don't really change the overall visual look, and you get quite a good amount of savings, especially when you're looking at case packs, which is something a consumer
Mm-hmm.
almost never sees. It's sitting in the
Right.
back in a DC and they're on their shelf, and the only time they ever see it is when someone's restocking it. And I can tell you, it's not captivating me enough to buy it whenever it's just sitting on a U-boat in the middle of the aisle, right? I'm looking for the
Mm-hmm.
pack. So
Well, one other thing I see quite often is, we have really passionate founders who are very committed to like the quality of their products, like the organic, non-GMO, vegan, sustainably sourced, et cetera, et cetera. Investing in those components when the product itself cannot be sold as organic. Like maybe you have 10 ingredients and you can only source 9 that are organic, and people are
Mm-hmm.
out there committed to that, which I understand, but your product cannot be branded organic. If you can't market that to the customer, I would suggest that maybe now isn't the right time to be leaning in hard on that and paying for a more expensive component. I always tell people, like, get your brand off the ground, gain some traction. There will be time to do some of the things you're passionate about later. For example, sustainably sourced XYZ, but you can't get to that point where you can make those decisions and those investments if your cost structure is so heavy out of the gate that you can't get off the ground. So I would just think about, like, I understand the commitment to some of those decisions. um, I would encourage people to think about the timing and like what it means to make those too early in the brand's trajectory.
No, that makes a lot of sense. Well, at what revenue level does it become worth investing real time and resources into formal margin improvement work? And what does that process look like?
I'd say you could do it on a lightweight way very early on. So like now, as soon as possible, you could do what we call it like is a biannual review of suppliers. Like even just asking or quoting a second partner so that they know there's some competition, you should be able to get something. And then just doing it, every year, twice a year. It could just be once a year if you don't have the resources, but I don't think you need to wait to do that. And if you build the muscle where you look at things every, once a year, because Lord knows your suppliers are raising your rates every year. So why shouldn't you be having those conversations? I would say that there is no revenue mark. You should be doing that from the get-go.
Yeah, I agree. And I think what Katie said earlier, it's understanding your true costs. If you don't even have the visibility to that yet, I think it makes it extremely challenging to know when is that time to do it. And it's not revenue based, it's based on your understanding of the business. And it's based on the whatever's triggering that. And it could be, now you understand where all these costs are going. Now it's time to go and renegotiate your freight rates or your costs for this specific type of packaging or whatever it may be. And also understanding the complexity around it whenever you're just getting off the ground. It's almost more complex than you really need it to be because you're doing all those things just to get a product made and out the door. Where trying to create simplicity around it now that you understand the business better allows you to understand where there's true cost savings.
I'd add one other thing that like a true like robust margin improvement project, like that is additional work. And a lot of times to really do that well, I would say you probably need at least 5 to 10 hours a week to make progress on that kind of an effort. And most of the brands we're working with, their teams are already strapped, right? So a lot of times you need to bring in an outsourced resource or make an additional hire to do that. So I just want to set the expectation that like expecting your existing team to do that on top of daily operations, the fires that inevitably come up. What happens is that work it's not urgent, so it doesn't get prioritized. So all that's to say, a lot of times it's helpful to have an outsourced resource come in and do an audit. And the cost for that, like to really make some meaningful progress, I would say is probably at least $10,000, $10 to $15,000 for someone to really spend a couple of months and dig into that. So when brands have the budget for that, like that might be an appropriate time to get potentially outsourced help.
Interesting. Well, this has been super helpful. I just want to open up. Martha, do you have any questions that you'd like to ask Jeremy and Katie?
Well, one thing I was wondering, it has been really useful to hear your insights and the two of you have so much knowledge. I'm wondering, are there like mentorship programs for food businesses so they can, learn some of this vast knowledge from a peer? Is there anything like that can help them build up their knowledge base so that they can operate more effectively in what's a very complex environment?
Mm-hmm. Yeah, there's a lot of trade organizations that cater to CPG. The Naturally Network is one. Naturally Colorado is the original and largest chapter. We are sponsors and partners with them as well. They have, I think they call it Founders Forums. They do have some programming for that. There's another one called SKU, SKU, which is an accelerator. They do take an equity position, but they have a mentor track. I think that's like 12 to 16 weeks, and you get support from all the different functional areas. On the lighter side, like Startup CPG is a great resource. Like that's really like peer-to-peer, like people asking questions and answering them. That's not a formal program. Although I'd be surprised if they didn't launch something like that in the next, year or two based on the way they're building that community. So those are 3 resources we give to people. I would just be aware that SKU, there's a compensation component in the form of equity for that program. Yeah.
Great. Thank you. And I guess just one other quick question then, as if a business is, like engaging a consultant, like, are there resources that you recommend that they use to evaluate market potential? Because that can be just really expensive to access data. And so, as they're kind of looking at what's the direction I want to build my brand, where do I want to launch my products?
Jeremy might have some better insight, but the first thing that comes to my mind is honestly farmers market. Like getting your product in front of people, getting real-time feedback. That is a lot of work, but you are going to talk to 100 to 200 people a day who are trying your product and giving you feedback on the taste, the price point, the packaging, all of that. I find that to be a pretty good laboratory.
Great.
Yeah, and what we used to do from time to time is we look at Google Trends. You can go into Google Trends and you can understand what's kind of relevant right now. I think a lot of people will look at that in terms of like whether launching a new product that they're interested in, or maybe even doing new product innovation that they maybe want to get into that market. But still to this day, and is protein, right? But now we're seeing a shift towards fiber again, which I know fiber was the it thing like 20 years ago.
Yeah.
So the market tends to cycle a lot, but it's always based on whatever the trend's going on now. And Google tends to be a really good read on that when you're looking specifically on the Google Trends site, not just Googling what's happening
Right.
right now.
Mm-hmm.
Awesome. Thank you both. Thank you.
Well, this has been great. Do you have any other advice or comments you'd like to leave with our Colorado Proud members?
I would just say surround yourself by advisors who will give you honest feedback, who are going to push back against you. Like CPG is definitely doable, but it is hard. It is hard, and you need to make sure that the market actually has a need for your product. And also, I would just suggest having folks who can help you shape what your goals are. Like a lot of the people we talk to, they want to be Siete Foods or Poppy. That's great. That is like a goal. That is one way to do it. But there's so many other ways. And I've also met lots of people who, want to grow to, a 500K or $1 million in sales and be profitable and do that through farmers market and regional. So I think getting folks who can help you be clear on what your goals are so they can frame your decisions is really important. And also know that your goals may shift over time. As people get a little bit older, maybe they have families or their desires change, like from a career perspective, like going after the Siete Foods, it may no longer serve you and you may want to like adjust your goals, which is okay. Things change, right?
Yeah.
So yeah, I think that's important.
Nice. Jeremy?
Yeah, I think that Katie mentioned this at the very beginning, was, growing your business slow is okay too, right? I think there's a lot of pressure in order to like grow your organization, see 20% year over year growth and just be like this rocket ship organization. And there are extreme challenges that come with that. And a lot of times, like she's saying, it may not be the right fit for you, for the type of business you want to run. And honestly, as I've worked in several very fast-paced startups before, and I'm kind of at that pace now where I'm like, I need to take a breather. As she said, I'm in a different stage in my life right now, and I think a lot of people in the organizations, when they're ready to start a company, it's okay if you're breaking even is huge. I mean, a lot of early stage startup companies don't even do that in the first few years. So if that's your milestone in order to prove that this business works for you and this is what you want to do, then make that your goal. It doesn't necessarily have to be this massive growth trajectory. And sometimes that's honestly just, it feels more sustainable and something you can do long term as well.
Mm-hmm.
Good advice. Well, how can our Colorado Proud members find Bravo CPG if they're interested in learning more about you guys, but also more about your company?
Yeah, we do. I mean, you can check out our website, bravocpg.com. We have a contact form on there if you'd like to speak to someone on our team, and also love to connect with people on LinkedIn. We put out a lot of content related to CPG, the challenges, the perils, the wins. So that's good to follow as well.
Great. Thank you. Well, I can't thank you guys enough. You're amazing experts. And the more I know we here at the Colorado Department of Agriculture engage with Bravo CPG, it's always so useful and great advice. And we love having you guys do these things. And Colorado Proud members, keep tuning in. Our next webinar is on July 21st, and we are going to be talking to Compost Colorado. They're doing some amazing work, and I think it's worthwhile for our small food businesses and all food businesses to take a look at how we can make an impact in composting. And don't forget about Cultivation Station, our podcast. In June, we're still going to be talking to Hell Yeah Salsa. They're a Colorado Proud member and making some incredible Colorado salsa and queso. And in July, we're going to be talking with the Rocky Mountain Farmers Union and all the resources that they're offering to our farmers and ranchers here in Colorado. Well, Martha, do you have any other questions?
No, just thank you very much for holding the webinar. I appreciate it. It's been really
Thank you
great.
for joining. You're a great partner as well. We always appreciate you and all the work that CSU does. So thank you, Jeremy. Thank you, Katie. And I hope you have a wonderful day.
Thanks
Thank
for
you.
having us. Bye.
Bye.